you're constantly adjusting your pro forma. And we do that on a yearly basis. And all good sponsors should do that on a yearly basis. When there is a situation where they have stopped distributions, you want to ask your sponsor, hey, what does your REIT forecast show? What is your exit? What is your new projected exit on this deal? What does our return look like in the light of this situation happening? So these are things that the sponsors should be doing. If they're not doing that, if they're like, oh, we actually haven't calculated that, that's concerning. You should definitely dig in further and figure out why that is.
Hello and welcome everybody to another episode. Today, we're delving into the topic that's crucial for every investor's playbook: navigating the challenging waters when a sponsor suspends distributions on your investment. It's a scenario that can test the mettle of even the most seasoned investors. In this episode, we're going to unpack everything from verifying the current status of your investment and the sponsor's standing, to strategies like reforecasting, to understanding exit projections, and the implications of capital calls and refinancing options. We're also going to demystify equity refinancing and delve into really what equity is and what it means to you as an investor. Furthermore, we'll explore the critical steps to take if you're considering exiting a deal, and the significance of the sponsor's ongoing activities and how they assess the deal and have access to capital. And a topic that's gaining more relevance in today's market specifically is the role of rescue funds put together by a sponsor. This episode is packed with insights, strategies, and practical advice. So whether you're currently facing the situation or just want to be prepared for the future, stay tuned. Today, we're joined by none other than Ravi Gupta, co-founder and COO of Viking Capital. Welcome, Ravi.
Thanks, Nathan. It's always good to be here. And I just want to congratulate you again. We reached a milestone. We have one raving fan of our podcast. And Neil, if you're out there, thank you for listening.
Sounds great. Hopefully that snowball's moving forward.
Yes.
Let's dive in. What exactly does suspending distributions mean for an investment?
Yeah, this is a great topic, and I'm really happy to be talking about this now because it's very appropriate in the given market cycle. This is an issue that many investors are facing. So, as you mentioned in the introduction, this is a perfect opportunity for us to go through exactly what you should be thinking as an investor in these types of situations. The reason why the sponsors may stop distributions are multifold, but the most common reason, especially now, is because of variable rate debt. Back in 2020, 2021, when agency debt, that's Fannie, Freddie, a lot of the institutions that lend at fixed rates, they were unable to meet expectations in the market in terms of pricing. And the only way many of these deals would work, almost all the deals would work, in fact, was using variable rate debt. And with that debt, it's another word for it is bridge debt, or sometimes bank loans would do the same thing. And what these lenders would do is they would lend a higher loan to value, but they would use variable rate interest so that if the baseline SOFR curve moved up in value, they would get more interest and your payments would go higher. And the way to actually ensure from a very high rate affecting the entire deal is to put cap rate insurance on the deal, which means that you have a rate cap that's a maximum amount that you will pay, and the insurance is put in place such that if it goes over, the insurer will pay the difference. And many assets currently are coming to an issue or coming to a point where their rate cap is expiring and they need to redo the rate cap or refinance. And those rate caps are super expensive. They could be anywhere from, $500,000 to $1 million to sometimes $3 million, just depending on the size of the debt that was taken at the time. So there's variable rate, rising interest rates, rate cap expenses coming up. Some sponsors didn't even put rate caps on the deal, and they're few and far between because many lenders required it. But some didn't put any. Some put very loose rate caps because they didn't think interest rates would rise so fast. So they're running into problems where they have minimal cash flow. And other reasons why people are in a tight spot where they can't give distributions to investors because revenue is decreasing. We're seeing a softening of the rental market throughout the United States. Also, expenses are increasing. Payroll is more, insurance is more, CapEx expenses are more. So all these issues combined together create an environment where sponsors will stop distributions.
Yeah. And those distributions come from excess cash flow, right? You have kind of income that comes from the property, you have those normal operating expenses, you have your debt service, you have kind of some operating fees, and then you really have that excess cash flow. And that is really where the distributions come from. And something I think it's important to clarify is a distribution, percentage, typically called that preferred return, whether it's 7%, 8%, that's dependent on the amount of capital that the sponsor injected or raised at kind of the front end of the deal, right? For CapEx, for closing costs, for actually purchasing the deal. And so the higher the equity is that you have to kind of bring to the table, the higher distributions are going to be kind of throughout the life of the deal. And to really simplify it, it's a math equation, right? If you have revenue or if you have income that's decreasing and you have expenses, whether that's operating expenses or debt increasing, that doesn't just leave a ton of excess or kind of net cash flow available for distributions. So,
Absolutely.
obviously it's not an ideal situation, but can you kind of discuss the importance of communication, specifically coming from the sponsor in a situation when distributions have to be suspended?
Absolutely. So this situation where distributions are suspended should always raise a flag with the investor. Obviously, it's pretty obvious you're not getting your distributions. You're like, what is happening? But oftentimes, we as investors will not really pay attention to the monthly financials or anything really that comes from the sponsor. And then when distributions are stopped, you may realize a year down the road, and that's not ideal. You really want to be on top of these things and make sure that you are getting your distributions as promised. But again, if you're not, that's a red flag. And what you should do is make sure that you are getting adequate communication. We've had this conversation multiple times on this podcast. If Neil, if you're as our raving fan, as you're listening, you know that we've talked about investor communication very often and how important it is. And if your sponsor is not communicating with you at all during this time, that's a big problem. That means that something bad is happening. You want to make sure your sponsor is communicating at a minimum on a monthly level, giving you full access to the financials so you can actually look at it, and also communicate why this is happening. In our communication, we always have some brief updates about what's happening at the property, but then also why distributions are paused if they are paused, and what investors should expect moving forward. So you want to make sure you see this. And you want to make sure your sponsor is maintaining proper operations of the property. That's another reason that distributions could stop, is because of some kind of negligence. And especially in this environment where, as I mentioned before, interest rates are going up, especially if you have variable rates, you're subject to that type of pressure. If your sponsor isn't maintaining proper operations, they're not maintaining the business plan as they said they would in the beginning, that could be a problem, and that can lead to decreased revenue and also hinder your cash flow. So you really want to understand the situation fully. You want to make sure that the sponsor is communicating with you. You want to reach out to the sponsor, make sure you're communicating with them and understand it. But at the end, something to really keep in mind is that this stopping distributions isn't necessarily a bad thing. And it feels bad to your wallet. You don't have that extra cash coming in. But these sponsors that are doing that for the betterment of the asset itself. As long as you've done all the things that I mentioned and you're verifying that you obviously trusted them to go into the deal, and you verified that you can continue to trust them, you really have to understand that they are advocates for you during this time. They are holding distributions, they're maintaining the property, they're trying to make sure that everything's working for you so that at the end, and we'll talk about exits in a bit, but you will get a profit on the exit. You're going to maintain the capital that you invested, and you're going to do well, and they're going to do well for you by the investment. So they're really in your corner. Once you do all that due diligence, keep in mind that they're in your corner. They're the ones that are helping you to make sure your investment is fruitful.
Yep. And pausing distributions is one kind of last line of defense, but it's better than the alternative of losing the asset, having to foreclose on the loan, having another operator take over the asset. So it does seem painful, but again, it's not as painful as some of the alternatives if distributions weren't paused, for example.
Yeah, and I'll tell you an example. There's, and I won't name names, but there's one sponsor that I know of that would continue to distribute even though the property wasn't really maintaining cash flow, and he wasn't able to pay certain operating expenses. His goal was to like just drain the property, squeeze it dry, and sell it for an organic appreciation. And he was successful several times. I mean, he did really well, and investors were really happy. They're like, oh, this guy knows what he's doing. But the way that saying goes is only when the tide goes out do you realize who's swimming naked. And this is what happens to these types of sponsors. They're not ideal operators, or not good operators at all. And they're not doing good by you, good by the tenants at the property. They're hoping for organic appreciation. You don't want that. You want somebody that really cares about the property, cares about you, cares about the community.
Yep. And ultimately, it's having that focus to sustain the health of the property itself, right? Because those distributions should be coming from the property's cash flows. And if the sponsor is choosing to supplement the cash flows in lieu of kind of bolstering the property's operations, it may make more sense to say, hey, we're going to kind of pause distributions and really focus on getting the property back up to where it needs to be, especially with kind of the variable rate debt that you mentioned, right? With how fast debt has risen over the past year or so, it's really tough to kind of claw that back with just operations, right?
Yeah.
Even if you operate the property perfectly, you can't really 3x, 4x your income in a matter of a couple of months to kind of offset that rise in debt.
Yeah, and there's a huge problem with softening of the market as well. There are many markets out there where the rents were being push, and then the tenants at this point have been pushing back considerably, and you're not getting those higher rents. Rents are dropping. We have a lot of properties in Atlanta that we see that all over Atlanta. A lot of bad debt. A lot of fraudulent activity. There's a lot of the books need to be cleaned up, and properties and cash flowing as well. So that's happening a lot. So higher interest rates, higher mortgage payments, higher insurance payments, higher payroll, and your revenue is dropping because of the rental market. I mean, it all leads to holding distributions because you're not generating that cash flow.
Yep. So let's talk a little bit about how you actually evaluate, a sponsor's current standing. Because if you're an investor and you are getting the distributions and you don't know if they're coming from the property or from the operator itself, what can you really kind of do to assess the viability of the sponsor and more specifically that deal?
Yeah. So that's very important because, I know sponsors out there who do one or two deals. They're not super experienced, or they have only done one or two deals and they're in this environment and they're very much struggling. And I also know sponsors that are also struggling, but they have done so many deals that they have the liquidity to back them up. And that's what you have to assess. See if the sponsor is still actively doing deals. That's actually a good thing. You want to make sure that there's still transactions happening because that's an income source for the sponsor. That's a way they can inject liquidity into deals that may not be doing well. That's a way that they have, GP share of another deal that's presumably going to perform much better. So if something were to happen, they have that to fall back on. I know there are a lot of investors out there that are questioning, like, hey, wait a minute. My deal's not doing great. This guy's doing other deals. Like, what's up with that? That doesn't make sense to me. But actually, that's a good thing. That means that sponsor is active. They're moving with the markets. They're continuing to maintain operations, and you want to see that. You want to analyze how the sponsor is performing in their other deals. If they have every deal every deal they have has stopped distributions, well, that's something to be concerned about. If they have like every deal with variable rate, they've stopped distributions, but the ones with fixed rate debt, they're still distributing. Well, then, that's not uncommon. You see a lot of that. In fact, most operators I know are in that situation. So you really want to see what's going on with their other deals. You can call their IR department, call the sponsor themselves, ask what's happening. They should be completely transparent and upfront with you. And just make sure that there's adequate liquidity in that deal itself. And that's something you can ask your sponsor as well.
Yeah. Let's pivot a little bit to reforecasting and reassessing the investment because we do this all the time on the underwriting front when we're acquiring the asset. We're constantly tweaking the underwriting, as we find new information. And that process doesn't really stop once you take over the asset, right? You kind of are always measuring yourself to pro forma, but invariably you're going to have to make some adjustments and kind of adjust the sales along the way. So when would you reforecast? What would be kind of the purpose of reforecasting? And what does that kind of do to kind of the overall outlook of the investment?
Yes, that's an excellent question, and you're exactly right in that we create a pro forma to start, and that is the pro forma is what we use when we approach investors with the deal. And whenever you're looking at a deal, it's all pro forma, right? It's future projections. It's the best guess of that sponsor. But then as situations come up, as there's a capital event, if there's a change in interest rates, change in expenses, what have you, you always should adjust that. And that's what reforecasting is. You're constantly adjusting your pro forma. And we do that on a yearly basis. And all good sponsors should do that on a yearly basis. So when there is a situation where they've stopped distributions, you want to ask your sponsor, hey, what is your reforecast show? What is your exit? What is your new projected exit on this deal? What does our return look like in the light of, this situation happening? So these are things that the sponsor should be doing. If they're not doing that, if they're like, oh, we actually haven't calculated that, that's concerning. You should definitely dig in further and figure out why that is.
Yep. Because the returns ultimately are going to have to be adjusted if distributions are paused, right? The way that preferred returns work is that, you're paid a certain preferred return, you're caught up at the end, and then that's typically when you split profit splits. But if you pause distributions, there's more kind of back end work that needs to be kind of done on exit to recapture that 7%, 8% preferred return in whole, and then the kind of leftover capital that's intended to be split is invariably going to be less because you've kind of used some of the capital to make up some of that shortfall. So, there are times, Ravi, when there's a certain amount of capital that has to be injected. It can be when distributions are paused. It can be when distributions are running fine. Can you talk a little bit about capital calls, refinances, pref equity, and how that kind of fits into the conversation we're having?
Yeah, and we've experienced this as well as a company because when you're in a situation where there are increased cap rates, rising interest rates, and you have to refinance, there's no way you're going to get the same leverage you got maybe a couple of years ago when you originally put the deal together. It just doesn't happen. So if you have to refinance in an environment where cap rates have adjusted and they've widened, and the lender is only giving you a, maybe like a 65, 70% loan to value, and their value is adjusted based on the current market, there's going to be a shortfall. And this is, again, not uncommon. And the way to bridge that shortfall is to get a pref equity piece on top of it. And there's multiple ways, but this is one way. If you're refinancing, say, for example, with agency debt, so Fannie, Freddie, or maybe even HUD financing or what have you, you have to get an additional piece of equity on top to bridge the gap between the debt and the amount of investor equity that you have in the deal. So it completes that capital stack. So when this happens, when you hear about this equity piece coming into play, what that means is you have a third party that's negotiated a favorable rate with the sponsor so that they, in fact, are senior to the limited partners, but junior to debt. So they're like in second place. So the primary debt is in first place, pref equity is in second place, and then you have your retail investors, your LP investors in third place. And what this means is that if there's any, as a cash flow comes out, it primarily goes to the debt first, then it goes to the pref partner, then it goes to the LP investor in that order. Once the deal's sold, the cash that you get upon sale goes to those positions in that order. So this equity piece is something to understand completely, because if the deal somehow goes sideways with that pref equity partner in place, sometimes they can actually take over the deal and sell it and force a sale and then get their money back, and then the LP investors are hung out to dry. So when this happens, when you hear that from your sponsor, hey, there's a pref equity partner in, just ask what the terms are for that pref equity piece. Like, hey, what's going on? What are the terms? What have you negotiated? Is it favorable for me? How am I affected by it? And these are all important questions to ask.
Yep. And sometimes, that pref equity is used for closing costs. Sometimes it can be used for renovations. I mean, I've seen instances where pref equities come in and been used for kind of a renovation budget. And the idea behind that is you get a new injection of capital that you can do renovations, you can upgrade the exterior that you might not be able to do in the kind of the first few years of the deal, and that will help in theory drive revenue. And then with compressed cap rates and whatever the exit holds, that pref equity piece will be kind of made full when they do get to exit the deals.
Yeah, that's a good point, Nathan, because I've invested in one deal where they didn't refinance, but they just brought a pref equity partner in because they needed a higher capex budget. CapEx expenses were rising very quickly. They knew they needed to renovate much more than they had projected. So they brought this pref equity person in, and they held distributions because of that. So that happens as well. So pref equity can come for multiple reasons, not just for refinance. That's a really good point.
Yeah. And kind of stacking on your point about refinance is that with a lot of these operators that have the bridge debt that are refinancing, into fixed rate debt, that brings some more security with those debt payments too, right? Part of the reason that some of the distributions were paused was that nobody expected rates to rise as fast or maybe as high as they did, and that caused dramatic increases in your debt service. But when you refinance into fixed debt, you have a bit more stability, a bit more predictability as to what your debt service is going to be without the risk of increases in the future. So even if you have a partner in there, there's more stability, more predictability, at least on the kind of debt service side of things.
Yes.
So let's talk a little bit about exit strategies. Considering exit strategies, whether it's potentially a refinance or kind of selling the deal, walk us through how that kind of plays into pref equity and distributions as well.
Sure. Actually, there are a couple points I want to make prior to moving on. You mentioned capital calls before. That's something that investors should be aware of too, because there are situations where cash flow has stopped, you've got distributions have stopped, and equities needed to be injected into a deal to make sure it's functioning, it's operating properly. and the sponsor may not have access to capital. They just need help. So they may reach out to you as a limited partner and ask for additional funds. And that's called a capital call. And that's one of the worst things to happen as an investor, when you see that your deal's sort of not performing as you were hoping. And then they're calling you and asking, your sponsor's calling you and asking for more money. It's hard to swallow and hard to digest, but sometimes you just have to do it because otherwise you may lose everything that you've put into the deal. When this happens, make sure you really understand the reforecast, how your capital is going to be treated. If your additional capital is treated as equity, because that can happen. You can say, hey, look, I'm going to fund you more, but I want a fixed return on this money, for the next 5 years, because this is additional capital. And sometimes your sponsor will structure it that way. They'll give you more for that capital call money that they've requested. And then also something else to add to that is that many sponsors are creating something like an opportunity fund or a rescue fund or something like that, where they're creating another type of vertical that investors could put money into. So they act as pref equity partners on maybe their deal, not only their deals, but other deals. So it's sort of a way to bridge that gap with investor money, coming from their own investor pool, maybe for their deals. But then also it's a way to be opportunistic in this environment and get some higher returns on other deals where some operators are really struggling.
Yep. And I like that term, rescue fund, because the idea is that you want to rescue the property itself, the deal itself, right? The alternative is letting a deal crumble, not be able to pay debt service, have to sell, lose investor capital, right? Lose investor trust. And that's kind of what the intention of the rescue capital is to say, hey, this is our hopefully a saving grace that can come in, inject some new lifeblood into the deal and get it kind of back on track. But again, you might not meet those kind of, initial projections.
Right.
And we talked a lot about theory and ideally what would happen, but can you give us a real life scenario of something that you've seen actually in the market where this has been instituted?
Yeah, absolutely. And I can think about a couple examples. I'll give you one example of a person that we know, colleague, who has been is in a situation where there's variable rate debt. There is a capital call, but the investors were very reticent about injecting more capital in this deal. They didn't like how it was performing, and this deal may foreclose. So that's like a kind of like a worst case example where it didn't work as expected. Kind of a best case example. I'll give you another one. I'll use one of our examples is where we had a deal that was highly performing, and we were able to get considerable rent bumps on the unit renovations, and it was actually beating all expectations in terms of NOI growth, but then we were very much restrained because of the variable rate, the rise of the rates, some higher expenses that we didn't really account for. So we had to refinance, and we actually ended up using CMBS debt. So that's just another type of vehicle. There's more room for negotiation. It's not as it's a little bit more difficult to negotiate a good CMBS loan. You really need somebody that's skilled in that area. But if you can get a very high leverage loan with a fixed rate that's quite low. And we've used CMBS a couple times. So we're able to leverage CMBS debt, get a very favorable loan. In fact, it was close to a cash neutral refi, but there were some expenses in closing that we had to take into account. But it was very close to cash neutral, and we're reforecasting the deal as cash flowing the next couple of years. So that was a good situation, and we created the best we could out of that situation. So two examples that I can tell you about.
Yep. And one thing to note too is that a lot of lenders, specifically in this market, are getting a lot more stringent with their requirements and their kind of debt tests for these refinances. And it's actually in the sponsors and the property's favor that they're taking a closer look, right? Because they're ultimately wanting to protect their capital too. And the more eyes that they can kind of lay on the deal and really make sure that it meets projections, the better off it's going to be for everybody in the long run.
Yeah.
Awesome. Well, thanks. This is a really important discussion. Any other words of wisdom to add?
Yeah, one last piece, and we spoke about this briefly, but just want to make sure you ask the sponsor when this happens what the exit strategies are. What are the options for an exit when they do refinance or restructure the debt, or whatever is happening? What does that look like for you? What does that look like for your return? You should have a good idea of how that looks, so you're able to project what your return will be for that that particular investment. But aside for that, I'm glad we have this discussion, Nathan. I think it's super important, especially given this time of the economic cycle. People really should understand these concepts. And if you like this discussion, please leave a comment. If there's something else you want to hear about, especially things that are relevant to this economic period, leave a comment. We're happy to talk about these topics.
Awesome. Thanks, Ravi. Catch you next time.
Thanks, Nathan.
Cool.
If you like this podcast, please hit subscribe or a thumbs up, and we'll see you next time.